Webinar on the subject of Solicitors Accounts Rules. Thanks for joining us today. Today I'm joined by Andy Holton.
Yeah, morning.
He's going to be covering some of the key points in relation to Solicitors Accounts Rules. So Andy, can you tell us a bit more about some of the latest changes that are taking effect?
Yeah, certainly. I've got a few. Can you put my slides up for me?
Yeah, sorry, Andy.
And then I can think about those. Yeah, we've got a few things to talk about this morning. So firstly, there are some new rules on when you can be exempt from obtaining an accountant's report. So when the solicitor no longer needs to obtain an accountant's report. So we'll talk through what those changes are. There are then some new reporting requirements, which essentially is the accountant's professional judgment on when a report is required. So in particular, we'll be looking at what is a material breach of the rules, what is a significant weakness, because it's all about when client money is at risk. If the client money is at risk, the SRA want to know about it. And that then leads into what work does the accountant now need to undertake given that change in reporting requirements. So that's what I'm planning to talk about in this video this morning. So let's move on and look in a bit more detail sort of at the reporting exemption. So this is when a solicitor actually needs to deliver a report. So at the moment, a recent change, the rules changed a year or so ago, we only need to deliver a report if it's qualified. So if we're just saying other than trivial breaches, then that's an unqualified report and that's all right. But if we put any detail in the qualified report, that needs to be sent to the SRA. There is also an exemption if the solicitor only holds legal aid monies, then they don't need to deliver an accountant's report. The one exception is that on top of these is that the SRA can always require a report. So if it's a condition of the practicing certificate or the firm's license that they submit accountant's reports, they must obviously do that to comply with that requirement. But we've got some new rules from 1st of November. So this is accounting periods that end on or after 1st November. So obviously we've clicked past 30th November 2015. Probably not many solicitors with that year end, but it would apply to that year end. More likely it's going to be relevant to 31st December 15 year end, so not far away in terms of when we need to apply these changes. So in addition to the exemptions I've already mentioned, there is a new exemption that comes in that if the average balance held on the client account, and that's all client accounts, including designated accounts, so not just the single client account, if the average balance exceeds £10,000, then we need to submit, or the solicitor needs to obtain a report. And then if it's qualified, they would need to submit it to the SRA. Or alternatively, if the maximum balance exceeds £250,000, then they would need to obtain a report. And then again, if it's qualified, they would need to submit it. How do we work out these balances? Well, they're worked out using the monthly reconciliation balances. So the SRA have taken a practical approach, which means that the information should be readily available to the solicitor, because the detailed rules that apply to solicitors aren't changing. They will still be required to carry out a reconciliation every month. So they will just look at the reconciliation balances for the past 12 months. What's the average? Did it exceed £10,000? Yes, we need an accountant's report. Did it exceed £250,000 at any time? Yes, we need an accountant's report. The fact that it's based on the reconciliation balances obviously means it's important that the solicitor does the reconciliation properly, and also that the solicitor doesn't indulge in any, what should we call it, window dressing of transactions. Now, obviously, if they did that, that would be a breach of the rules, because to get the money out of the client account when it shouldn't be, that would obviously be a payment that's not in accordance with the rules. But if the solicitor does that and then presents the accountant, perhaps you just also do the solicitor's own accounts, and says, look, here's our reconciliation balances, they're all under 10,000 and all under 250,000, you as the accountant wouldn't know what the solicitor had done to do that. So it wouldn't be your problem, it would be the solicitor's problem. Obviously, if you became aware of that during your work on the solicitor's own accounts, then I think you obviously need to point that out to them in the management letter quite forcibly, because that would be a serious problem if the SRA became aware of it. But obviously, all of our solicitors are good people, and that's not going to happen. Moving on swiftly. So what are the new reporting requirements? We've determined that our particular solicitor needs to engage an accountant, so the average balances are over £10,000 or whatever. What are the new reporting requirements? Well, essentially, it's all about, from the SRA's perspective, is client money safe? And that's what they want to know about. If there's anything that means that client money isn't safe, that puts it at risk, then they want to know. But they're leaving it to the accountant's professional judgment to determine whether client money is put at risk. So that puts a lot more onus on the accountant to decide whether there's a serious problem. So on the plus side, it means that we won't be submitting qualified reports virtually every year for most solicitors and reporting pointless breaches of effectively meaningless rules, which is what we do at the moment. So it's moving in the right direction. The problem that we have is that the detailed rules still remain for solicitors. So the background to this is, at the moment, the detailed rules that the solicitors comply with haven't changed. The onus is on the accountant to decide, is client money at risk? i.e., have we got a material breach? Have we got a significant weakness in systems? So an obvious question is, what is a material breach, or what is significant? The SRA are aware of this issue, that they're aware that they're actually putting the onus back on the accountant. So they have actually issued some guidance notes which indicate what they believe would be material and what they believe would be significant, to give the accountant some guidance, if you like. So I've got a list here of some of the items. This list I'm going to run through isn't exhaustive, it's just illustrative, and certainly the overriding factor here is that if you believe something needs to be reported to the SRA, then you report it. It's your judgment as the reporting accountant that matters. Obviously, you need to be able to substantiate that judgment. So the sort of things where we've got serious factors, the SRA have suggested. So if we've got a significant shortfall, if we've got or an unreplaced shortfall in client monies, then that's serious. That would need to be reported. If we've got evidence that we've got sort of willful disregard of the rules, so basically the solicitor is deliberately breaching the rules, deliberately putting client money outside of a client account, for example, actual or suspected fraud involving solicitors or employees, where there's a risk to client money as a result, they would want to know about that. Material breaches that the COFA hasn't reported. So there is a system whereby the COFA should be carrying out certain checks, identifying weaknesses. If the COFA identifies material breaches, they should be reported to the SRA even before you start your work on the year end or at each period end. So if that process isn't working, that's a serious systems failure. The SRA want to know about that. If we've got no or inadequate accounting records, or alternatively a significant failure to provide you as the reporting accountant with access to files. So certainly a qualification at the moment is, you ask to see a particular file and the solicitor says, no, it's privileged, I'm not showing it to you. That's fine, that's the solicitor's prerogative. You qualify your report, because the SRA, if they want to, can go in and look at that file. And that will be the same issue here. If in the work that you decide is necessary, and we'll come on to that in a moment, you ask to look at a particular file and you don't get access to it, then you would still be qualifying the report because you haven't had access to a file that you requested. If the solicitor is using the client account as a banking facility, that you're not allowed to do that. That's a serious breach of the rules. They've then also identified some moderate factors which they think wouldn't automatically result in a qualified report. So there's a bit more of a grey area. So for example, if we've got a significant shortfall that was replaced, so something went wrong and the solicitor spotted it and put it right straight away, depending on the circumstances, you might not need to report that. Certainly if it was caused by a bank error, then the chances are you wouldn't need to report that. But banks mess things up on a regular basis, and at the moment it's normally a breach of the rules. we can now apply our professional judgment and say, the solicitor has acted correctly at every turn. It's only the bank that has messed up. Therefore, we don't need to report that to the SRA. If we've got actual or suspected fraud or dishonesty of third parties, we'd need to consider that. If material breaches haven't been reported within a month, so whilst the COFA is doing their job, perhaps it's not happening as quickly as it ought to. Perhaps the SRA would want to know about that. If the accounting records are insufficient or unreliable, obviously if there's none at all, we've got a serious problem. If they're just not very good, well, at what point does not very good become a significant weakness? That's obviously a much grayer area where your professional judgment comes into play. And again, a poor control environment. If we've got a few breaches of the rules that happen occasionally, I think we can, in immaterial areas, we can probably conclude that they're not significant. But if we've got lots of breaches happening on a regular basis, that's suggesting actually the systems aren't very good. And is that something broadly that puts client money at risk? A lot of emphasis is placed on the reconciliations. They're obviously significant to determining whether a report is required. It's also a key test on actually a particular point in time, is the right amount of client money in a client account and is it safe? So that if the reconciliations aren't happening, that's something that we would need to think about reporting. Alternatively, finally, they've mentioned the SRA long-standing residual balances. So obviously the solicitor is meant to write to the client immediately and identify this matter is now finished, where do we send the money back? If any is left over, that's a weakness if that's not happening. Or alternatively, improper use of suspense accounts. Obviously now with internet banking, it's quite possible that the solicitor will have a receipt appear in their client bank account and they don't know who it's from. So in the short term, it's quite proper that that goes into a suspense account, but as soon as it's identified, it should come out again and be placed in an appropriate account. So improper use of a suspense account, again, is illustrative of issues. So that's just SRA guidance on some of the issues that you would be considering are either material or significant. What we've done in the documentation that we write in client money programs published by Wolters Kluwer, we've essentially created a checklist that you run through at completion that's just asking questions about whether you've come across any of these matters that either you think then might give rise to a material or to a significant breach. So that then leads us on to the actual work that we need to do. Because Rule 39 has been deleted. So Rule 39 previously set out a whole series of detailed tests that you had to carry out. That's gone. So the work that you need to do is now just driven by your professional judgment, which then should obviously be based on the risk assessment and tailored to be appropriate to the solicitor. But I think it's important to note that the detailed rules applying to the solicitor remain in force. And therefore, from the SRA, I think the risk for the reporting accountant is that you identify a number of breaches from your work, you conclude that they're not material, then the SRA, with the benefit of hindsight, if something goes wrong, will come back and say, well, you identified this breach and this breach and this breach. Why didn't you tell us about it? So it's very important to document the work that you consider necessary, and also why, particularly where you've decided not to report something, justifying why you haven't reported. Because if something does go wrong, a very obvious question to you is, you knew about this, why didn't you tell us? And that's why it's placing more emphasis on where things go wrong on the accountant. So the accountant's got to make sure that aspect is documented. So what work do you actually do? Well, I think certainly I would start from the basis of, whilst we've got these detailed rules in place, and the idea is that in due course those detailed rules will change. The SRA have indicated that an outcome-focused version of the rules is going to be issued next year. But in the meantime, in the context of the detailed rules, I would start with effectively the full programme So when we're planning our work, our starting point is we will do the full program we do at the moment, and I would then modify that based on my risk assessment of the solicitor. So perhaps in a bigger firm where they've got good systems, where the COFA is actually doing their job properly, we could scale back a lot of that detailed testing and take a much more systems-based approach to confirm that things are appropriate, perhaps focusing on reconciliations, focusing on overdrawn client accounts and things like that as focuses for our work. Alternatively, typically in a smaller solicitor where the systems aren't as good, perhaps the COFAs, I hesitate to say not really up to it, but perhaps not quite as good as they could be, would be a better way of putting it. Perhaps we would need to do more of that detailed work, focusing on risk areas like suspense accounts, residual balances, missed postings. Have we got lots of journals around the client ledger? And you may end up doing a lot more of the detailed work pretty much as you do at the moment. I think in particular I would certainly still be requesting a bank letter at least at the year-end date, and perhaps at an intermediate date. A bank letter is still a good evidence that the client account is a client account, that the funds are safe at least at a particular point in time. Bank letters are difficult, but we have now a new online facility for getting those bank letters, so that might make things more straightforward. But it also means that if you do have issues with particular bank letters, you can actually take a risk-based judgment as to whether you actually need a letter or not. But certainly the specific requirement to obtain a bank letter and reconcile at a particular date has disappeared. So again, with the work, it comes back to the professional judgment of the accountant, and therefore it's important to document why you've ended up with the approach that you have. So a risk-based approach, that should then, what's the response to that risk, setting out the work that you plan to do in those areas. So those are the key points that I wanted to talk about.
Okay, that's great. Thanks, Andy. And when will the relevant work programs be updated? Are we expecting any time soon at all?
We've actually already updated the programs, and the updates are currently with Wolters Kluwer, so they're being processed at the moment. So the online version of the programs may go live before Christmas. Certainly the paper version will be published in January. So we're expecting it to apply mainly to December year ends as really the first time then where this is going to kick in. So you'll have the programs in place before you need to start planning the December year ends, and obviously for subsequent month ends it will be available.
Great. Okay, thanks very much. I hope that's been useful. It's very sort of top level, so it's obviously there's a lot of points to cover there in just a short half-an-hour video webinar. What we are doing in February is we're running a full hour's webinar on this particular subject. That's running on the 15th of February next year from 1 o'clock till 2 o'clock, being held by Julia Penny. What we'll do is we'll email some details of that round to everyone who's attended today, in case you're interested in attending that, to get some more information on that on this particular issue. This live video webinar will also be available to watch as a recording within the next 10 working days. So if you have any colleagues in your firm that would want to watch this video webinar, that will be available to you free of charge as well. Well, I hope today's been useful. Thanks for Andy. I think we touched on some important points there. We hope to see you again very soon. Thanks very much.